Want $100,000 for your business or startup? In this video, I'll tell you exactly what you need to do and have for lenders to approve you, including the three things nearly all lenders look for. I'll tell you how lenders calculate the offer they present to you, how they decide between 25K to 250K, and I'll talk about timing because when you apply for a business loan matters. The outlook for interest rates is looking good, and I'll explain why now may be a great time for you to look and apply for financing options. Be sure to watch this entire video, even if you're not looking for financing now or you're still feeling burned from the EIDL program, trying to figure that out. Still watch this video. I promise it will be valuable. And as always, thank you for subscribing, turning on alerts, so you never miss out on funding or business information. After watching this video, if you're ready to go apply for financing, go check out our partner, Fora Financial. They've helped a ton of businesses at Skip get approved for loans from the tens of thousands to the hundreds of thousands of dollars. They're a longtime partner, link in the description, more on them later. Before I get to the three things you'll need to keep in mind before applying and how lenders calculate the offer for you, let me talk about the timing, why now in 2024 it may be a great time for you to consider financing. Again, this will all depend on the state of your business, but I want to show you this. This is the target Fed funds rate. You can see it's gone up and down. Let's focus on this half. Prior to the pandemic, it was around 2.5%, dropped near zero interest rates. Many folks rushed for very, very low interest loans. With inflation skyrocketing, the Fed has pushed up interest rates to around 5.5% plus or minus. That's where we are today. The good news is it's stabilized. As far as everyone believes, rate increases are over. Not only that, it's predicted the Fed will lower interest rates between now and the end of the year by 3/4 of a point. This is based on a poll. The U.S. Central Bank will cut the federal funds rate by 25 basis points in September, November, and December, taking the range to around 4.5% by the end of the year. And this, of course, matters for borrowing. This affects every type of borrowing: personal borrowing, mortgages, business borrowing. Typically, when financial institutions decide on how much interest to charge you, they base it on the federal funds rate, also known as the prime rate, and add percentages onto that. Typically, it's about 3% higher than the federal funds rate, although it can be much higher. Here are common interest rates according to Google. SBA 7A loans can range from 13.5 to 16.5. Traditionally, interest rates may be lower there. We may see those drop in the coming months. Traditional bank term loans, 6% to 12%. Online term loans, 6% and up. Business line of credit, 10% and up. Merchant cash advances, typically as a factor rate of what you're borrowing. So if you need capital, there's a variety of options out there. If you had been waiting for years, what you may want to consider is looking at options today, seeing the offer you get, and then you can decide, hey, I want to wait for rates to lower, or I want to take this loan now. I always recommend knowing your options, which leads to the second point. What are the three things lenders look for? And third, how they decide on the offer to give you. But let me first say, if you are ready to go apply or see what you may be eligible for, go check out Fora, because they typically only require these three things: a FICO score that's around 600 or higher. Sometimes it can be lower. They'll want to see recent bank statements, looking for an average monthly deposit of around $10,000, $15,000, somewhere in that range. And they want to know that you've been operational for 6 months or more. They have funded all types of businesses. Again, go check them out. Our partner link is in the description. So I mentioned the three things Fora as a lender looks for. And of course, this varies by lender, bank that you're applying with, but it is credit, time in business, and revenue. Most will want to see a 600 score or above. So do your best to take care of your own credit first. There's a ton of ways to get help with your credit. You can always book a time via our website to talk with us. We can talk about your credit or getting you better prepared to apply for financing, what we like to call funding ready. There's usually two types of businesses: those that are funding ready and those that aren't. The second piece is time in business. If you do not have an entity yet, like an LLC, S Corp, C Corp, Highly recommend doing that, or at least having formal documents for your business. Lenders will want to see that. If you want to get a business entity on the Skip profile page, you can click Get a Business Entity. While you're there, you can even get a business plan, which is another thing some lenders look for, especially when applying to, say, SBA 7A, SBA microloans. They may require a business plan. You can request one on Skip, which leads to the third and most important criteria, which is business revenue. In the case of Fora, like I said, they'll only require some bank statements from you. For larger loans, they'll need more information, such as a tax return, profit and loss statement, balance sheet. So keep those in mind. And by the way, we have a funding ready checklist on the Skip dashboard. Click My Documents, Funding Ready Checklist, and you can securely store your documents here. So when you go apply for financing, you have everything you need. So those are the three main things most lenders are looking at. Certainly with larger loans or specialized loans, they'll request more documents, but I wanted to share those to demystify the loan process. Many of you may feel like it's going to be a pain in the neck, but it turns out many of the applications can be painless with quick turnaround times, so you're not left wondering or you have to do a whole bunch of back and forth. And finally, to the third point here, how much lenders will approve you for. Well, many lenders will use the debt service coverage ratio, aka DSCR, to determine how much you can pay back. That's based on your cash flow and current debt obligations. It's answering the question, do you have enough income to pay back this debt if we give it to you? If not, we will need to lower the amount we're giving you. I won't get into the math, but basically it's your net operating income divided by your total debt service. A DSCR of 1 means your company has exactly enough operating income to pay back the financing. Of course, if it's less than 1, that means you have negative cash flow and you certainly won't be able to pay back that loan, at least until you increase your cash flow. Many lenders will set a minimum DSCR of 1.2 or 1.25. A DSCR of 2 is typically considered very strong. So for example, if you're getting a $100,000 loan, the repayment schedule is factored into this calculation based on your current cash flow. And if it comes back that your DSCR is 1 or negative there, the lender may try to calculate again and put in $50,000 and say, okay, you know what, this is a better DSCR 1.2, 1.25 that we can offer to you at good terms that we feel good about your ability to repay. As always, there's other financing options on the Skip dashboard, including a line of credits, and of course, for a link below if you want to go check them out today. Are you in need of financing now or planning on applying in the near term? Let me know in the comments. Most importantly, thanks for liking this video. Stay well, stay healthy, and I'll see you in the next video.